AVV Nation, all of YouTube, what's going on? My name is Patrick France, Senior Instructor here at VectorVest, and this week is an important week for the major US tech players. We've already seen one of the FANG stocks report earnings last week, and no surprise, had a pretty significant drop right afterwards. So to prepare you guys for this week, we're going to be taking a look at the remaining FANG stocks and see what's going on, what the VectorVest analysis tells us, and give you guys a little bit of an earnings preview for the major tech stocks out there. So if you guys are ready to learn, as always, make sure to subscribe if you're not already subscribed and smash that like button to help us out with the YouTube algorithms if you enjoyed today's video. So with that, let's go ahead, get right into the software here today. All right, welcome back. Now let's jump right into it here today. So as we know, the major tech giants all have earnings reported this week, with Google starting us off coming in tomorrow, Tuesday, the 26th, followed by Facebook coming in on Wednesday, and then Apple and Amazon both reporting on Thursday. And what I want to do is first off, take a look at the analysis, and then we'll dive into their charts because there's something in the charts that you really need to see. So make sure to stick around for that part. So starting off with Google, we'll work our way from left to right. And the first thing we always do whenever analyzing any stock here at VectorVest is compare the price of the stock to its value. The reason why is because here at VectorVest, we believe in buying stocks that are undervalued. So therefore, we're looking for the current price of the stock being below its current value. So for Google right now, it is undervalued, meaning you're getting a discount based off what the stock should be worth. After the value, the next four indicators are all going to be cast on scales of 0 to 2, and above one is good and below one is bad. So starting off with the RV or relative value, this is looking at the long-term potential of the stock over the next 1 to 3 years. As we can see, all of these stocks do have good long-term potential over the next 1 to 3 years, with Google being the leader of the pack. The next indicator is the RS indicator, relative safety. Now this is looking at the consistency and the predictability of their financial performance. In essence, it's making sure that the company is meeting those earnings or growing those earnings quarter over quarter, year over year. And to keep it simple, the RS is simply looking at the amount of risk involved in the stock. So if it has an RS above 1, that shows less risk with the stock, below 1, more risk with the stock. And once again, no surprise, Google takes the cake for the RS rating as well. Then we jump into the RT, or the relative timing, which is looking at the short-term price trend of the stock. Now, on a scaling of 0 to 2, above 1 would indicate that the short-term trend of the stock is up, below 1, the short-term trend of the stock is down. Well, as we've seen since throughout all of 2022, all the major tech giants have been getting beaten up pretty bad. So no surprise here to see all of these companies having a relative timing below the level of 1, indicating that they have been in a short-term decline, and they still are. With Facebook being the worst performer with an RT of 0.32, and then Apple being one of the best performers at 0.99. So doesn't bode well so far. Yes, these companies have good fundamentals. Yes, these companies have strong balance sheets, but they've still been getting beaten up with the market. And as we saw with the Tesla earnings, even if you have great earnings right now, you're not really being rewarded like you have been in the past. So always keep that in mind. Sometimes, even if the company does grow earnings quarter over quarter, year over year, it's all about the overall market perception. And that is one thing you always have to be mindful of here. So looking at the VST rating, the overall rating of the stock from both a fundamental and a technical basis, all of them are favorable still. Amazon just barely above that level of 1, with once again Google coming in as our top performer with the VST rating of 1.28. Then the last indicator we want to take a look at is the CI, or the comfort index. This is more of a technical indicator. I like to call it the snapback factor. In essence, stocks that have a high CI tend to bounce back after a pullback and create that new high quickly. So, all of these not looking so great with the CI rating, Apple being the best performer at 1.31. But typically, if you're looking for a high momentum stock, one that can really bounce back after some sort of pullback, you really want to look for that 1.5 or higher range. So therefore, right now, all of these stocks have an either hold or sell rating. So gives us a little bit of pause here when we look at these, especially going into earnings and seeing what the overall market's been doing and seeing how earnings have been rewarded over the last few weeks as well. So since we're going to be talking about earnings today, I do want to highlight the GRT. This is looking at the forecasted earnings growth rate shown as percent per year over the next 1 to 3 years. And as we can see, Google has a forecasted earnings growth rate of 29%, Apple 23%, Facebook 20%, and Amazon 24%. So now that we're speaking on that earnings growth rate, let's go ahead and jump into the charts and see what those tell us. So we'll just go ahead and graph all of them here. There we go. Now we're in the charts. So starting off with Google, what I have in my charts to make sure you guys are all familiar with it is we're looking at the price shown in candlesticks over the last year. I have a 3-in-8 exponential moving average to show short-term momentum, which way it's going. And then below there, I have the earnings per share, since we're talking about earnings here today. And then below that, the GRT, or that forecasted earnings growth rate. And then at the very bottom, we have volume as well, but we're not really going to be getting into that too much here today. So looking at Google, the one thing we always talk about here at VectorVest is when we're looking for stocks we want to be buying, we want to see a price rising from bottom left to upper right. We also want to look at the earnings per share moving from bottom left to upper right, like a stair-step pattern. So Google, definitely meeting that criteria. The company is growing their earnings and expected to continue to grow their earnings quarter over quarter, year over year, going forward for at least the next 12 months. And as we always say, earnings is the engine that drives stock prices higher over time. So if the company's earnings are growing and expected to continue to grow, then we should see that price move along with that as well. But I wanted to look at the forecasted earnings growth rate as well, because that is something to take into account. And looking at the forecast earnings growth rate over the last year, it does seem to have peaked right around November when we saw the highs coming in the market. Since that point, it's been relatively flat and now starting to move slightly lower, showing that that growth rate may be slowing down a little bit. And that brings me to the one thing we really wanted to talk about here in today's video. This is a great example. We'll see more of it here in a few moments. But when looking at it, it's about the perception the market has on an earnings rate or an earnings beat or an estimate, all of that. And what we're seeing is, yes, the companies are still making money, but they are slowing down a little bit. And that could give the fearful investors out there, which there's a lot of right now, that cause to pull the trigger, sell their positions, or major investors to sell their positions, and could see the stocks continue to decline. Because yes, while they're still making money, they're growing their money exponentially. They're not growing it as fast as they have been in the past. And so therefore, people could perceive that as weakness, which could drive the prices down from an earnings call in the short term, but on the longer term still remains in positive situation because the company is still growing. They're still making money, just not quite as much money as they have been over the last few years. So this gives us a little bit of a warning sign that we're seeing as we go through some of these stocks. So therefore, with Google, we definitely want to be cautious. We do have a support floor or resistance zone now at this point, right here at around 2,500 a share. So we are below that. We broke through that on Friday, trying to climb back a little bit here today, but keep an eye on that 2,500 level to see how we react to that point. Moving on to the next one, taking a look at Apple. Once again, similar situation we were noticing with Google, but a little bit more pronounced. So the price is steadily rising from bottom left to upper right. We definitely like seeing that. Looking at earnings, bottom left to upper right, telling us the company is making money and they're expected to continue to make money 12 months down the road, which should come as no surprise. Company owns or has more money in hand than our government does. So yeah, no surprise there. But then we look at the GRT, or that forecasted earnings growth rate. Well, peaked in November and has been slowly drifting lower over the last 6 months or so, telling us, well, yes, the company is still making money. They're not expecting to be continuing to make money quite as fast as they have been. So we are starting to notice some potential signs of some slowdowns coming in for some of the tech stocks, which is the effect of inflation, interest rates rising, and everything that you've been hearing on TV recently. So looking at it though, right now, Apple is kind of in no man's land, or just sort of hanging out, moving sideways. We notice a top here right around 180 a share. And then we have a floor being formed roughly right about 150 a share. Yes, it pierced below that a couple of times, but quickly came back. So really, we're trading in this range between 180 and 150. A good earnings performance could see that pop back up above the 180 level, but poor earnings performance or guidance that isn't quite meeting what everybody else wanted to hear could drop us below that 150 level, and we could see that moving lower on the short term. So keep that in mind and be cautious with that as you move forward with this one. Next one is Facebook. As we know, Facebook missed earnings last quarter. We saw the drop coming in there, similar to Netflix. Netflix missed last quarter and missed this quarter. We saw the first drop and then a second drop coming in right afterwards. And no surprise, I mean, Facebook could have that earnings miss, and we're noticing the similar situation that we've seen with other ones where the earnings are steadily rising, but the forecasted earnings growth rate is dropping pretty quickly here. At the same time, you look at that earnings per share, while it is higher compared to a year ago, it's lower than its peak from November and starting to drift lower. So that gives us some negative signs, something we haven't seen with the other two so far. And now, this could be something, where Facebook is having a lot of issues where they're giving poor guidance going forward. They're already setting the tone that they're expected to see user activity dropping. They're not collecting as much ad revenue. They're pushing more money into their metaverse. So there's a lot going out right now with Facebook and not a lot coming in. Now, maybe they have something up their sleeves that we could see be announced during that earnings announcement, but based off of what we're seeing right here, I'd be extremely cautious if you hold this in your portfolio and take some defensive actions, whether that be through the use of options or contra ETFs, whatever it may be. Definitely keep that in mind coming into the earnings play coming in on Wednesday. So wanted to point that out as well. Then as we move down to the next one, Amazon. So Amazon is an interesting one. We've seen the forecasted earnings growth rate dropping for a while. It is starting to flatten out a little bit. We are starting to see earnings start to pick back up. So this one could see a potential run coming in, but overall, the way we've seen earnings beats be rewarded here over the last couple of weeks doesn't leave me with a lot of positive signs as we move forward. Even if they have strong earnings, if they don't have the greatest guidance going forward, we could see the markets take their price down even more from where we're currently at. So be cautious with this one as well. So hopefully you found today's video useful. Hopefully you've learned something from today's video and helped you be more prepared going forward for this week. Really, just to recap, the overall mentality that we're noticing, these stocks are making money, but not quite as fast as what they have been over the last few years, which indicates a potential slowdown in some of the big growth stocks. So therefore, be cautious as you move forward throughout this earnings season, especially this coming week, if you hold a lot of these tech giants in your portfolio. So let me know your thoughts down below, and until next time, toodles.